It has been said that we are living in one of the worst economic times since the Great Depression. Banks are no longer lending like they used to. Money is tight. Loans and credit lines are hard to come by. Retirement plans are down by up to 50% or more, and the government is looking to increase the amount that businesses and business owners must pay in taxes. There is no doubt that it's getting harder and harder for business owners like you. If you've recently tried to get a loan or a line of credit from a bank, you know exactly what I'm talking about. Automobile financing. You see, when it comes to financing, most people focus on two things when they buy a car: price and interest rate. Yet, even if you get a car loan at just 8.5% APR, 25% of your car payments will go toward interest. When you consider the number of cars you will purchase in your lifetime, that's a ton of money. Let's assume you'll buy a new car every 4 years for the next 44 years, so 11 cars total. Each car will be financed for $10,550 and can be financed at 8.5% interest for 48 months. You have a choice with how to pay for these cars. You can use one of 5 methods. You can buy them through a bank or other finance company, lease them, pay cash for them, use an interest-earning savings account, or use your own bank by using the infinite banking system. Let's look at each method in further detail. Buying the car through a bank at 8.5% interest would cost $260 per month, which is $3,030 per year. Over 44 years, that amounts to $137,280. Leasing a car costs a little bit more. Why? Because you lease from the owner of the car. Is the owner a fool? No. He will make some money on the activity. Let's then assume that leasing will cost you $175,000. Paying cash for the car will first require you to save up for the car, so you would have to defer buying the first car for 4 years. The overall cost for the cars would be $116,050, which is the $10,550 times 11 cars. The last two methods both involve having a banking mentality. The difference is using your own bank versus using someone else's. Let's compare. Assume for the last two methods you understand the need to capitalize your bank, so you accumulate $5,000 per year for 7 years before purchasing the first car. You could accumulate your money in a savings account and buy certificates of deposit at someone else's bank in the amount of $5,000 with a yield of 5.5% interest. However, this interest is taxable, so the after-tax effect is 4%, assuming a 30% tax bracket. After 7 years, you would have $41,071 in your account. So, you buy your first car and continue to make the $3,030 car payments into your savings accounts. By year 50, you would have $258,927 in this account. Alternatively, you could accumulate your money in a dividend-paying permanent life insurance policy instead of at someone else's bank. For the first 14 years, putting your money in someone else's bank comes out ahead. But from that point forward, the infinite banking concept is favored in an accelerating fashion. In fact, by year 50, you will have $964,638. That's $705,710 more than putting your money in someone else's bank. Why is this? Because when you become your own banker, you are the only owner of your bank. So you receive the profits that would otherwise go to the bank. It's that simple and that powerful. There really is no comparison. So, congratulations once again on your decision to become your own banker. You will soon be in a position to stop supporting the employees and shareholders of other banks and finance companies through all of the interest you're paying to them, and instead use that money to support you and your family. You'll soon discover that becoming your own banker will prove to be one of the wisest decisions of your lifetime.
Well, the market is, to say the least, a bit shaky. Interest rates have taken a dive. Where can you be sure of a decent return. You might want to consider life insurance. Yes, life insurance. Same expression I had on my face about 10 years ago when we said commodities. Joining me now is Joe Hyder, president of Dawson Wealth Management in Cleveland, and Adam Sherman, president of First Trust Financial Resources in Philadelphia. Dennis is with me as well. Joe, I'll start with you. Explain why you think this should be a new asset class for individuals, because we did hear that same thing a few years ago with commodities, which were then not an asset class for the general public. And it's turned out to be a big bet for a lot of people and a good one for people. Why life insurance now?
Well, it's simply taking the commodity that banks, corporations, and college endowments have been utilizing as a safe bet, long-term investment with high interest rates, virtually no volatility, and liquidity. And now we're simply looking at this as a potential for play for a portion of our clients' money and portfolios for safe long-term money.
And Adam, you agree that life insurance should be part of your portfolio. How much? What kind of a return should you expect too?
Well, Sue, in today's volatile marketplace, with money markets at 2% and 5-year CDs at 3%, the current crediting rates of permanent life insurance policies are now 4 to 4.5%. So depending on the size of a client's portfolio, we would like anywhere between 5 to 10% allocated to this new asset class.
Dennis?
Well, hey, Joe, simple
Yes.
question. Do I have to die to reap a really good return on this investment?
No, you don't. The reality is, when Adam was talking about crediting rates in the 4 to 4.5% rate of return, it's very competitive with certificates of deposit and money market, but it has the dramatic added advantage that you pay no income tax on those gains ever if it's structured and the withdrawals are done properly.
Can I spend those gains, though, as I'm going while I'm alive, or could you spend those gains only after the policy pays off?
No, you can spend them while you're alive, which is the utilization that companies and banks have been utilizing for decades now to fund employee benefits and retiree benefits.
Okay. Hey, Adam, you know, back at Forbes magazine, we always learn there's term life insurance, where you're just kind of placing a bet, and if you die, it pays off big. And there's whole life, and we were always taught whole life bad, term life good. Which are we talking about here?
Well, we're talking more on the whole life side, and I'll take it a step further. Universal life, or call it permanent insurance in general, these products are, the internal rates of return over a 20-year period could be anywhere between 4 and 5% if they're with good quality companies. The industry itself is a AA industry, so we feel pretty good about parking clients' monies in these contracts.